The following is a sponsored program paid for by First Alliance Credit Union. Welcome to Good Money Moves, featuring Jenna Taubel from First Alliance Credit Union and Andy Brownell. Here's Andy Brownell on Rochester's News Talk, 1340 KROC AM and 96.9 FM.
It is time for Good Money Moves on News Talk, 1340 KROC AM and 96.9 FM. I'm Andy Brownell along with Jenna Taubel, AVP of Marketing at First Alliance Credit Union. Hello, Jenna.
Hey, Andy. How are you?
I am great. So last week, our conversation was about buying a boat or boats and all the other stuff associated with it and the costs you have to consider as all that before you become a boat owner.
Yes.
What are we going to cover this week on Good Money Moves?
We are bringing back the conversation to home equity again this week.
All right.
Specifically to dig into the differences between home equity lines of credit and home equity loans, which we touched briefly on in one of our recent episodes on this topic.
Right.
So before we dig too deep into that, just kind of a quick recap for our newer listeners and maybe those who didn't hear some of our more recent home equity episodes where we've been talking about what that is, what it means, how you use it, how to build it. Home equity is simply the difference between the amount you owe on a mortgage and what the home is worth. So more technically speaking, home equity is the property's current market value minus any liens, such as mortgages that are attached to the property.
Sure.
So it's essentially what you own versus what you owe in your home is kind of a fun way to think about it. Own versus owe, right? So the amount of equity in a house can then grow over time as you make payments and the property values increase. Now, why this is such an important tool for homeowners to understand is because your home's equity is an asset that you can borrow against to help meet important financial needs, such as possibly paying off higher interest debts or using it to fund improvements to your home, whether those are planned or unplanned. And how you access that equity is through financial tools such as home equity lines of credit, also known as HELOCs. You'll hear people say that, HELOC.
Hear it all the time.
Yes. And home equity loans. They both allow you to borrow against the equity in your home, but they are two products that actually function differently, even though they're using that same collateral.
Okay. So I guess let's start with the home equity loans. Exactly what is it and how does it function?
Yes. A home equity loan is a type of loan where you borrow a fixed amount of money using the equity that you've built up in your home. So think of it kind of like getting a second mortgage on your home. The amount you can be approved for is usually a percentage of the equity you have in your home. So if you have $50,000 in equity, you might be approved to borrow 90% of that amount, or what would equivalent be of like $45,000. So once you're approved, you receive the money in a lump sum and pay it back over a set period. Getting that lump sum of money can be really great for large one-time expenses like major home renovations that you're planning for. Home equity loans also have a fixed amount that you borrow with a fixed term, which is usually between 7 to 10 years, and a fixed interest rate, which tends to be a bit lower than, say, like a personal loan, because you have that secured equity from your home.
Yep, collateral.
That collateral, exactly. Which then results in fixed monthly payment amounts. So this can help make it a lot easier to budget because your monthly payments are predictable and there's a specific period of time in which those funds are going to be paid off. So you know exactly how much you need to pay each month, and which is just really helpful when you're planning your finances. Now, some of the other benefits to think about when it comes to home equity loans. They also have downsides, right? Everything has benefits and downsides on this show. We always talk about them. So once you've taken out that loan, you can't borrow any more on it without applying for another loan.
And that might be considered a positive as well.
Yes, it just depends on what your goals are, which we'll talk more about later. If interest rates drop, you would need to refinance to benefit from those lower rates, which can involve additional costs because home equity loans and lines of credit come with closing costs similar to mortgages. Not quite as expensive as a first mortgage, but they do have closing costs involved. And of course, as with anything, when you are using your home or the equity in it as collateral, you do risk losing your home if you default on that loan because your home, again,
Sure.
is that collateral. So some things to keep in mind.
I think the best case scenario for these home equity loans would be if you did have that major renovation, you're going to, put a brand new kitchen in, something that adds value to the home.
Yes.
And you're, using the equity as a tool to achieve something that is increasing the resale value of the property at the same time.
Exactly.
Yeah. And obviously it's probably a pretty darn good option if you have a specific expense and you're looking for that stable and predictable payments. So that flips us over. What do we need to know about the HELOCs, the home equity lines of credit?
Yeah, so a HELOC or a home equity line of credit is also a type of loan, but it works more like a credit card. So you are given a line of credit up to a certain amount based on your home's equity that you can borrow against and pay back and borrow against and pay back over and over during that draw period, which is usually about 10 years. You can borrow as much or as little as you need up to that limit and then repay it over time. So during that time, you're also only paying on interest on that amount that you've borrowed, not the entire credit limit.
Oh.
Yeah, which means this offers a lot of flexibility, but be careful because there's a temptation to overspend up to your credit limit, which can lead to some financial trouble if you're not careful. So again, just like credit cards that have those limits, you still need to be spending wisely and be paying attention to how you are managing this financial tool.
And I'm guessing you don't want, it's preferable that you don't max it out.
Yes. Yeah. You can max it out. Just be mindful about paying that down quickly. So HELOCs usually also come with variable interest rates, meaning that the rate can go up or down over time based on market conditions. Some lenders do offer fixed rate HELOC options, but they're less common. So what this really means is that your monthly payment can vary, which can make budgeting a bit more challenging. And that variable rate is, again, more typical, which can be both an advantage and a disadvantage depending on how those rates move sometimes. So overall, a HELOC is really suited for situations where you need ongoing access to funds, or if you're not sure how much you'll need up front. It's really great for variable expenses like home improvements, or even as like a financial safety net for emergencies. There's a lot of people who will just take out HELOCs once they have some equity built in their home and just let it sit there in case they need those funds to tap into. Because if you're not advancing those funds, you don't owe anything. So it's another option.
Okay, so the minimum payment on the HELOC during the draw period only covers the interest, correct?
Yes.
But you always have the option of paying more than that and paying down part of what you owe.
Exactly, because once that draw period ends, you move into that repayment period where you do have to start paying down that balance as well as the interest.
Okay,
so
but if you were really prudent, you could have the whole thing paid off before the end of the draw period.
Correct. Absolutely.
Okay.
Yep.
Just wanted to make
Good
sure
clarification point. Yes.
But so what you're saying is when you get the end of the drawdown period, if you have not paid off, it converts into an accelerated payment schedule that includes the principal.
Correct.
Okay. I think I've got it.
Good.
All right. We have to take our break. When we come back, we can talk about maybe the impact of both of the types of home equity loans, the HELOC and the home equity, straight loan on, I guess, your credit scores. How it might affect that. On Good Money Moves with Jenna Taubel with First Alliance Credit Union, I'm Andy Brownell, and we will return in just a moment on News Talk 1340 KROC AM and 96.9 FM.
Good Money Moves continues in moments with Andy Brownell and Jenna Taubel from First Alliance Credit Union. This is News Talk 1340 KROC AM and 96.9 FM. We're talking Good Money Moves with Andy Brownell and Jenna Taubel from First Alliance Credit Union on Rochester's News Talk 1340 KROC AM and 96.9 FM.
It is Good Money Moves. Jenna Taubel with First Alliance Credit Union. I'm Andy Brownell. We're talking about home equity loans and HELOCs. I like saying HELOC. It's kind of a neat word or acronym. So I guess we went into the break with a question, so I'll ask it now. How does each type of home equity financing affect your credit scores?
That is a really good question. And the short answer is that both a home equity loan and a HELOC can and do impact your credit score. They are not exempt from that. Now, there's a couple ways that it can be impacted. So we'll just kind of break it down. Applying for a home equity loan or a HELOC will require what's called a hard inquiry by your lender, which can lower your credit for a short period of time. So, but it's a very small blip and it doesn't last very long. The other way that you're going to see a home equity loan or a HELOC impact your credit score is, of course, through payment history. That's a huge component of what makes up your credit score, which is why managing this home equity account responsibly can help build your payment history, which is a major factor in determining your credit score. So you want to avoid things like late or missed payments that can also have a larger impact on your credit score. So really, it's just important if you're using these financial tools, just like any other financial tool, that you are borrowing responsibly and that you're keeping up with payments and so that you can maintain that good credit score. And then just remember that because your home is essentially the collateral for this loan, just like if it was your mortgage, defaulting on either type of loan could potentially lead to foreclosure. So be very mindful of that. Make sure you're making those payments. However, making those payments consistently on time is likely going to help your credit score improve in the long run.
Okay. How about if I'm making just the minimum payments on specifically the HELOC? Would that be helpful to my credit score or the other way around?
Yeah. So you're getting into a really great point, the credit utilization aspect of having a home equity line of credit. A home equity line of credit can affect your credit score, but not the same as other types of revolving credit. So not like credit cards. The FICO credit scoring model excludes HELOCs from that 30% credit utilization ratio because the credit line is secured by your home.
Sure.
So yeah, and a lot of people don't realize this. So using a HELOC to pay off credit card debt could also help improve your credit utilization ratio, but affect your length of credit history. So there's some checks and balances there, right? If you're using a HELOC to pay off all this credit card debt and then you go and close all those credit cards that you maybe had that long credit history with, you could see a decline in your score for a temporary amount of time until you have that payment history built back up with that HELOC. But it's not that utilization ratio is not taken into account the same way that those credit cards were. So it
Okay.
can, yeah. And then the other thing just to kind of keep in mind too, that not necessarily directly related to your credit score, but adding a home equity line of credit or a home equity loan to your financial obligations does increase your debt to income ratio as well, which is taken into account if you do want to, access other forms of credit down the road, whether it's a vehicle loan or a credit card or a personal loan, whatever it is, that does impact your debt to income ratio,
Okay.
those types of loans.
That's interesting that if you used it to pay up the credit cards, it more or less erases your credit card history.
If you close those cards.
If you close them. Okay.
Yeah. Yep.
So you could potentially pay them off and let them sit dormant if they don't have fees.
You could. Yes. Yeah.
Okay. Interesting. How about the interest rates? I mean, between the home equity loan and the HELOC, the home equity line of credit, and you mentioned fixed versus variable. Is there anything else I should say, we should know about the differences?
Yeah, that's a really good question because I don't know that we necessarily have dug into what that means in any of the previous episodes where we've talked about HELOCs or home equity loans or home equity in general. So HELOC rates tend to be variable, and they are usually set based on the prime rate plus a margin. And the prime rate is based on the federal funds rate. The federal funds rate is the interest rate that the Federal Reserve sets for financial institutions to borrow from each other. Probably more information than you need to know.
Because this is what we always wait every few months for the Fed to make their announcement. This is what they're talking about.
Exactly. Yeah. So HELOC lenders use prime as like that base rate. And sometimes they will offer HELOCs at that prime with no markup, and others are going to mark it up an additional like 2 to 3%. So what this means is if prime is 8.5%, which is what I think it is as of the recording today, HELOC rates could range anywhere from 8.5 up to 11.5. So you take 8.5 plus that 3%, you get 11.5. So that's what they're basing that on. And that, of course, also is affected by your credit score, your loan amount, all those things. Now,
but
home
it's still
equity,
very, very competitive when compared to credit card rates.
Very competitive. Yes, much lower than credit card rates. So home equity loans have fixed rates, and they are usually at an even lower rate than HELOCs, and they aren't necessarily dependent on prime for pricing the way that revolving credit is. So at the end of the day, regardless of the final rate that you qualify for with either types of loans, whether you're looking at a HELOC or a home equity loan, your final rate is going to be likely dependent on other factors such as your home's loan to value, your credit score, your loan amount, your debt to income ratio rate, all of those other factors that are being taken into consideration when you apply for any type of credit from a financial institution. But that's really the key difference is that prime rate that they're basing off of for HELOCs.
I have one more question before we take a break.
Okay.
You mentioned that the fixed rate home equity loan includes closing costs. Does the HELOC also have closing costs?
Yes. Yep. They both have closing costs attached to them. So and it's typically, some lenders will charge just a flat fee. Others will charge a percentage of the loan for those costs. So make sure you ask about that.
Lots of things to consider. That's for sure. All right. We're talking HELOCs and regular home equity loans on Good Money Moves. And we'll learn some more when we come back with Jenna Taubel with First Alliance Credit Union on News Talk 1340 KROC AM and 96.9 FM.
Good Money Moves continues in moments with Andy Brownell and Jenna Taubel from First Alliance Credit Union. This is News Talk 1340 KROC AM and 96.9 FM. With We're talking good money moves with Andy Brownell and Jenna Taubel from First Alliance Credit Union on Rochester's News Talk, 1340 KROC AM and 96.9 FM.
The topic today on Good Money Moves, home equity loans and HELOCs, home equity lines of credit. So Jenna, was there anything else I should consider, or maybe we review what we should be considering when I'm looking at tapping into my equity in my home and considering either a HELOC or the home equity loan?
Yeah. I think when you're considering using equity in your home to fund whatever it is you're looking to fund, whatever goal you're looking to meet, and you're looking at either that home equity loan or you're looking at the HELOC, it really comes down to what are your financial needs and what are your goals for needing to use this financial tool. So a home equity loan, again, it gives you a lump sum with fixed payments and a fixed interest rate, which is going to be best for larger one-time expenses. And a home equity line of credit, or a HELOC, on the other hand, is a revolving line of credit with variable interest rates, and it has that flexible borrowing, more like a credit card, making it ideal for those ongoing or unpredictable expenses, so you can tap into it as needed. Now, if you need a specific amount of money for a large one-time expense and prefer those predictable payments, that home equity loan is likely going to be a better choice for you. If you need ongoing access to funds with more flexibility, a HELOC is going to be probably more suitable. Just remember that both options use your home as collateral through your equity. So just make sure that you're borrowing responsibly and make sure that you understand the terms and the conditions that come along with those loans. Know exactly how you'll use the money, make sure you can keep up with the payments, and just as with any type of lending, just do your due diligence. Make sure you understand what your obligations are when it comes time to make those payments.
Know what you're getting into. Is there any scenarios? Have you ever seen it where somebody has both? That they use a portion of their equity to take care of that one-time expense, but also has the HELOC as that kind of a backstop?
You would have to have a lot of equity to tap into to have two of them, first of all. I'm sure it's happened. I'm not going to say it doesn't, but I don't know that it's necessarily common.
All right. Just I guess that leads to other alternatives out there. If is there any other way to do this other than HELOC or home equity loans?
Yeah, there are definitely a couple of alternatives you could think about, but again, it really just depends on your financial goals for needing the funds in the first place. So another fairly common way to access the equity in your home is through something called a cash out refinance, which I don't know that we've ever truly talked about that on this show before.
I don't think so.
That could be a whole nother episode. See, just when you think we're running out of stuff to talk about, I throw out things like cash out refinance.
Write to yourself a note there.
Yeah. So you could consider a cash out refinance, which essentially allows you to refinance your existing mortgage and then take out the extra cash based on your home's equity. So this, also similar to a home equity loan, would get you a lump sum similar to that home equity loan, but you're essentially refinancing your existing mortgage. So you're not having those two loans, you're just having the one.
This is what I would consider a second mortgage, is what you're saying.
It essentially, but you are paying off your original mortgage.
Oh, okay.
Yep. Yeah, you're refinancing your whole mortgage, but instead of refinancing it for what balance is owed, you're basically refinancing it for the full amount of what that home is worth, so that you can capture that equity as cash.
Got it.
Yes. So another option to consider is a personal loan, though the interest rates are usually higher. This can be really beneficial in situations for like debt consolidation, where you don't maybe need as large of amount of funds as you could tap into with a home equity line of credit or a home equity loan. So it can be a really good option for things like debt consolidation if you're considering that. For smaller, shorter term needs, there's nothing wrong with a good old credit card. with, look for those that have like that 0% introductory rate to kind of save yourself on the interest. And it can be really actually advantageous, especially if you're able to pay it off before that introductory period wraps up and you have those rate increases. So again, it really just depends on what your purpose for needing the funds are, the amount you need, what your ability to repay looks like. And again, each option has its pros and cons. So it's just important to take some time, do your research to really choose what is best for your situation.
And as part of that research, and I hammer it home for you, Jenna, is that monthly budget. Because if you have that monthly budget set, you can actually really do a good comparison and get a much better idea of which one would be most advantageous in your situation.
100%. Always, before you go to apply for a loan of any kind, know your current budget and what you can actually afford to repay.
Due diligence, as we like to say.
Yes.
Great information. Learned a lot today, actually. And I'm sure we could spend a lot more time talking about HELOCs, especially. So if I want to learn more about home equity and how to use that as a responsible financial tool, or other aspects about financial literacy and making good money moves, where can I go?
Yes, as always, I encourage our listeners to visit our website at firstalliancecu.com. You can subscribe to our blog. We release new financial tips and advice there every week. You can listen to past episodes of this show at firstalliancecu.com/podcast or on krocnews.com. You can also subscribe to Good Money Moves on Apple Podcasts, YouTube Music, and Spotify. And as always, I encourage you to reach out to our team at First Alliance Credit Union so we can help you start making good money moves today.
That's First Alliance Credit Union, federally insured by NCUA and an equal housing lender. This has been Good Money Moves with Jenna Taubel with First Alliance Credit Union. Thanks, Jenna.
You bet.
And we will do this again next week and have more Good Money Moves for you on News Talk 1340, KROC AM and 96.9 FM.